If you have ever been baffled by the math behind promotional auto financing, I mean, how can a manufacturer offer 0.9% financing or, a killer lease deal that just seems way below market rates?
Uh-huh. It looks like magic, but it's actually one of the most sophisticated cash management operations out there. Really quite complex.
And that's what we're diving into today, right? The mechanism behind it all.
Exactly. We're looking at subvention. It's this core financial link, this transfer between the manufacturer, the OEM, and their own finance company, the captive.
Okay, so our mission today is to kind of unpack that. We need to understand the target rate they aim for, the bar rate.
That's the one.
Then get into the two main kinds of subvention, the accounting rules, which sound important, and then this idea of negative subvention, which sounds weird.
It is a bit counterintuitive, yeah. But let's start with the foundation, the bar rate. This is absolutely key. It's the target yield, the minimum return the captive has to make on every single deal.
Right. If they don't hit that number, they're losing money on that specific loan or lease.
Precisely. And it's not just like their borrowing cost.
No, our sources show it's way more layered. You've got risk baked in, operating costs, all of it.
Exactly. It kicks off with their cost of funds, sure, what they pay for capital, but then they stack on crucial reserves. There's a credit reserve for defaults,
Yeah, I said.
an RV loss reserve for lease depreciation risk, plus, running the business operating expenses, dealer support, and, of course, their own required profit margin.
Looking at the example in the source material really adds up. If cost of funds is, say, 5%,
Yep.
you add maybe 0.25% for credit risk, another 0.25% for residual risk, factor in ops and profit. And suddenly that bar rate target is, what, 7.05%?
Exactly. 7.05% in that example. That's the hurdle. That's the real rate they need to earn.
So, okay, 7.05% is the target.
Yeah.
The customer sees an ad for, 3.5%. Big difference.
Huge gap. And that gap is precisely where subvention steps in.
So the buy rate is the low advertised rate, the one the customer gets.
Right.
And subvention it's cash.
The OEM.
Oh, yeah.
It's a lump sum cash payment. Yeah. Funded directly by the OEM, paid upfront to the captive, it makes up that difference. So the captive still achieves its 7.05% target yield, even with the low customer rate.
Okay, but how do they know how much cash? Is it just a guess?
Oh, no, it's very mathematical. It's all about present value, PV. They calculate the difference.
How does that work exactly?
Well, they look at the payments the customer will make at that low 3.5% buy rate. Then they figure out the present value of that payment stream, but using the higher bar rate, the 7.05%, as the discount rate. The difference between the original loan amount and that discounted value, that's the exact chunk of cash the OEM needs to pay up front. It's calculated for every single promotional deal.
Got it. So it's precise, immediate capital transfer.
Okay.
Okay, that makes sense. But you mentioned there are different types of subvention.
That's right. It's not just one thing. It basically serves two main goals, depending on what's being financed. It can lower the payment, or it can help manage risk.
Let's break that down. What's the first type?
The first is probably the most common one people think of, rate subvention. This is for your standard loans or finance leases.
Okay.
And its whole purpose is just to cut the interest rate the customer pays. Simple as that. The OEM pays that upfront cash, and it lets the rate drop from, say, our 7.05% bar rate down to that 3.5% promotional buy rate.
So using our numbers, the OEM is essentially buying down that, 3.55% difference over the long term, paying the present value of it upfront?
You got it. That's rate subvention, relatively straightforward.
Okay, what's the second type then?
Now, the second type is residual value support. This one's really interesting, especially now with market volatility. It applies mostly to operating leases.
And this isn't about the interest rate.
Not directly. Here, the OEM is stepping in to guarantee a higher residual value on the leased car at the end of the term than what the market analysts might predict.
Like ALG, those guys who set the standard residual forecast.
Exactly. If the market thinks a car will only be worth 50% after 3 years, but the OEM needs a lower lease payment to sell more cars,
They might artificially bump it up.
they might support, say, a 54% residual in the lease contract, that extra 4%. The OEM is essentially insuring the captive against that potential loss if the car comes back worth less. Our sources specifically mention this being used a lot for EV leasing, where future values are, well, uncertain.
Interesting. So they're managing the captive's risk. Is there a formula for the cash payment here too?
There is. It's based on the MSRP, the percentage of RV support they're offering, and critically, the expected return rate.
Expected return rate, what's that?
That's the percentage of leased cars they actually expect to get back at the end of the term. Not everyone returns the car, some buy it out.
Okay.
So let's say you have a $50,000 car. The OEM offers 4% RV support, that's $2,000 if every single car comes back. But maybe they only expect 75% of them back.
So 75% of $2,000, that's $1,500.
Right. $1,500 is the effective support commitment, and since that's an upfront payment, they calculate its present value using the bar rate again. So that $1,500 might translate to an immediate cash transfer of, say, $1,176.
Okay, $1,176 upfront. But wait, this is where you said the accounting gets really specific, right? These two types of upfront cash, they're treated differently on the books.
Absolutely critical difference. And it all comes down to a core accounting principle, matching income with the service provided. You can't just get that cash up front and call it revenue right away.
Okay, so let's take rate subvention first. That cash is basically covering future interest payments the captive won't get from the customer because of the low rate.
Correct. So under IFRS rules, that upfront rate subvention payment becomes part of the loan asset itself. It's added to the initial growth carrying amount.
And the income.
The income, the interest, is recognized gradually over the whole loan term using the effective interest rate, EIR method. It just becomes part of the yield earned on that loan asset over time.
Okay, that makes sense. It's tied directly to the interest function of the loan. But what about the residual support cash? That little $176 in our example.
That's different. The OEM is paying the captive to take on future risk. The risk the car won't be worth the guaranteed residual. That service, taking the risk, happens over the entire lease term.
Ah, okay, so the income recognition has to match that period.
Exactly. The rule is very clear. That upfront residual support payment must be recorded as deferred income initially. Then it has to be recognized as revenue over the lease term, usually on a straight line basis.
So that $11,176, if it's a 48-month lease.
You divide $1,176 by 48 months. That's about $24.50. That's the amount of subvention revenue the captive recognizes each month in their P&L.
Okay, so they can't just book it when they get the cash, and they absolutely can't wait until the end of the lease either?
No, the sources are very clear on that, recognizing it only at the end when the car comes back or all up front. That violates IFRS. It has to be spread over the term.
Got it. Strict rules to make sure the financials reflect the timing of the service provided. Now, let's get to that twist. Negative subvention. We've spent all this time talking about the OEM paying the captive. What on earth happens when the captive pays the OEM? That completely flips the script.
It does sound backward, but it absolutely happens in captive finance. It means the captive is sending money back to the manufacturer, and it's not always just simple profit sharing.
So why would they do that? What's the first scenario?
The main one is managing, let's call it, the credit profile. Imagine a customer who's maybe subprime, higher risk.
Okay.
They might actually qualify for a buy rate that's higher than the captive's bar rate target. Let's say the bar rate is 7.05%, but this customer's rate is 10%.
So the captive is making extra profit on this deal.
A lot extra. But maybe the dealership network and the OEM want to maintain a consistent look for their promotional programs.
Ah.
So even though the captive earned well above its target, it might pay that excess, that delta between 10% and 7.05% back to the OEM. It helps keep the OEM's marketing and dealer offers looking uniform, even on these more profitable, higher risk loans.
Wow, okay, like an internal balancing payment? What's the other reason?
The other common one is hitting volume targets. If the captive finance arm helps the OEM achieve certain sales goals, maybe moving a specific model.
Right, like end-of-year pushes.
Exactly. The captive might pay a kind of rebate or incentive back to the OEM based on hitting those agreed-upon volume or penetration targets. It aligns both their goals. The OEM wants sales. The captive provides the financing to enable those sales.
So pulling this all together, subvention isn't just a simple discount. It's way more strategic.
It's definitely a dual-purpose tool. The OEM uses it to influence pricing for the customer, yes, but also critically, to manage financial risk, both credit risk and residual value risk within its own finance arm.
And the big takeaway seems to be you absolutely have to get the accounting right. Those models need to be spot on.
No question. Accurate Excel models, strict adherence to IFRS.
Yeah.
Because those upfront payments, whether for rate or residual support, must be recognized over the period the service is delivered. It's about proper financial reporting and compliance.
Well, that certainly demystifies a lot about those car deals. It's been a fascinating look into the engine room of auto finance.
It really is a complex system.
But here's a final thought for you, our listener, to chew on. We've seen subvention supporting sales, but think about that negative subvention scenario. When the captive pays the OEM, partly to cover high-risk customers who are already paying above the target rate. What does that imply about the pressure on the captive's own risk models? And how much of that internal risk sharing is truly visible to anyone outside the company? Something to ponder.
A very interesting point. Lots of hidden dynamics there. Thanks for digging into these sources with me today.
Absolutely. Thanks for listening, and we'll catch you on the next deep dive.